Hello everyone. In this video, we will see what span of margins are provided by two online brokerage firms, Zerodha and Alice Blue, to identify which one will provide the best margins so that we can trade conveniently. For this, we will see the intraday futures and options margin and the carry forward futures and options margin provided by these two online brokerage firms. The first thing we should know is that these margin numbers given here are not going to be the same every day based on market volatility. These prices will change on a daily basis, and we can see these changes in the prices and the margins. Now, let's see how this is. First, let's go into the margin calculator of Zerodha. Okay, let's see the Bank Nifty margins for that is given here. Bank Nifty 27th December, which is this one. And here we see the initial margin and the exposure, and this is the margin, the amount that is required. Now let's look at the equity futures and options given by Zerodha. Uh, we saw the Bank Nifty, we will see this here again. And here it is, Bank Nifty. And before we identify what these numbers are and what these columns are, this is the NRML margin, that is the normal margin, and this is the MIS margin, that is for the intraday. So this one indicates the amount that we need to have for trading in the intraday, and this is for normal carry forward. So back to Bank Nifty here. Yes, this is the NRML margin, 54,569, and this is the intraday margin. So to trade in Bank Nifty futures and options, we need to have 19,099 according to for trading in the Zerodha platform. Now let's see Alice Blues. Alice Blues equity futures, and we have here the Bank Nifty for 27th December. Here again, it's for normal day trading. Again, the columns, this is the NRML margin and this is the intraday margin. And here is the Bank Nifty 54,569, which is the same NRML margin as Zerodha has provided here, 54,569. And for Alice Blue, the intraday margin is 5,056, whereas Zerodha has 19,099. However, this is just for Bank Nifty. Let's look at one more. Let's look at Nifty. Nifty here, where is it? Yes, here is Nifty's margin needed by Zerodha is for NRML, it's 82,135, and the intraday margin required is 28,747. Let's look at Alice Blues. Here it is. For NRML, normal margin carry forward, that is, we need 82,135, which is again similar to Zerodha's. And for intraday trading, it's 8,213. So this margin is just 1/10 of the normal margin. That means Alice Blue is providing an exposure of 10 times, and Zerodha is providing a margin of around three times, or maybe slightly more than three times the amount. Now, this is just Nifty and Bank Nifty. Let's look at a normal stock and how a normal stock trading will and what margin we will need. Let's look at the first one, that is ACC. And for ACC, here is the NRML margin, that is 1,05,452, and the intraday margin required is 47,453. In Alice Blue, this will be ACC, that is NRML, again it is the same, 1 lakh 54 1 lakh and 5,452, and for intraday it's 10,545. This is where Zerodha and Alice Blue differ. Zerodha keeps giving a margin that is around two times or three times, and Alice Blue keeps giving an exposure about 10 times the amount. So if you have just 10,000, you can start trading in the ACC Limited stock. Now we have seen the equity futures. Let's look at bracket orders. Bracket orders for, hmm, let's look at the same stock. That is, so the price of futures is ACC Limited. So it is, the price is 1,507. Let's go 1,507. Let's have a stop loss of 10 points, so it'll be 1,497. And if we calculate, we will need a margin of 4,762 to trade in this. Let's look at the same thing in Zerodha. Bracket order, same thing. NSE futures, ACC, it's 1,500. Let's not go 0.2. Let's do again 10 points. 497, same number. Let's buy this. Calculate, and for for trading in Zerodha for the same stock, we need a margin of 20,255. Whereas in Alice Blue, we need only an amount of 4,762 for trading in the NSE futures and options. That's just the bracket orders. Let's look at something else. Let's look at the commodity. And here in commodity, this is the most popular one right now, crude oil. So let's look at crude oil. The crude oil's normal margin is 58,222. The intraday is 5,822, provided by Alice Blue. So this again, Alice Blue is providing an exposure of 10 times. And Zerodha commodity. Let us look at crude oil again. Normal margin is 58,222, and the MIS margin or the intraday margin 29,111. So for commodities, Zerodha is providing an exposure of two times the amount. That is the commodity this is the commodity margin for crude oil. Let's look at the bracket order for commodities. MCX crude oil. The amount is 3386. Let's look 3386. It's changed quickly. 6. Continue. Calculate. And we need a margin of 1303 for bracket order in commodity. And let's look at Zerodha's bracket order for commodity again. Here we have MCX, crude oil 3386 was it? So let's look at 376 of just 10 points difference. Calculate, and here the margin required is 4741. Whereas in Alice Blue, the margin needed for trading in this is 1303. As you can see, Alice Blue seems to be providing a better margin and gives more exposure for trading. We have to remember that there is always a risk involved in market trading, and it can be expensive trading in these stocks and futures and options. And since everybody does not have a huge amount to continuously trade in the stock market and bring in profits, we decided to uh, compare do a comparison of two brokerage firms and how much margin they provide and what kind of exposures is given. This this comparison is also to help us identify how we can conveniently trade in these markets, and this will help us to become better traders. And since we have as we have seen between Zerodha and Alice Blue, if you would like to trade, all you have to do is register into Alice Blue's. Here is the open an account link. Just go into aliceblueonline.com and click here to open your own account. Thank you for watching this video. For more videos on stock market, please subscribe to the channel.